Hi everyone, David Melly here. Today we're going to do something really cool and interesting, and it's going to be something important for you for the rest of your life. You need to know compound interest and the importance of it for creating wealth and trying to break out of the norms of living paycheck to paycheck. The wealthy, pretty much anywhere you go in the world, know the power of compound interest and time. So what we're going to do today is I'm going to show you how to create and get compound interest, and we're going to use the future value or FV calculation. Just kind of like, it's very similar to the way it works in Excel, but we're going to actually do that with calculated columns in Power BI to come up with something like this. So let's look at our data first. So if I go to Excel and I bring this guy up, so I want to look at this. This is our actual Excel sheet. And if you notice here, all I have on this is the example. I have A through H. I have type, and I have these columns labeled, so present value, additional payments, and interest rate. That's our primary things we're looking at. And then we got term, which is the years. In this case, we're looking at all 25 years. And then compounding periods. So each year will have 12 compounding periods. So we're going to compound by monthly, but you could actually compound weekly, bi-weekly, quarterly, or yearly if you want. You would just change this number to whatever that corresponded to. So obviously if you did it daily, you wouldn't have 12 days. You would have 365 days a year. That would be 365 here. But, all right, so for the purposes, what we're doing is if you look under the type column, you have multiple ones for present value and additional payments, AP, and interest rate, IR. What I did was I wanted to show you when I pull this through to Power BI, how we're going to look at and how these things can change investments over time, right? So most of these are at 10%. I've got one at 5%, so we can see the difference there. I've also got present value. So what if they put in $1,000 up front? What if they put in $2,000? That's this one down here. And what if they put in $0? That's this one here. Also, for additional payments, what if they put in 100, 200, 300, or $0 per month? So this is by month for additional payments. And we want to see what effect that has on this money over time. So this is the only data we need to have to be able to calculate the rest. So again, we've got it broken out by example. I don't have to have these first two to do this. I just am doing this so that I have, 8 different examples here, A, B, C, D, E, F, G, H. And I have multiple ones that some of them are multiple inside the same one. So I can filter them as I want in Power BI. If I want to have present value only ones, I can do that, and I'll show you that in a minute. Additional payments, interest rate, term, and compounding periods. All I need. Then from there, what we're going to do is bring this up. So let's look at this. So once I'm in Power BI, I bring that data in. You can see it right here, sheet 1. I have the additional payments, compounding periods, example, interest rate, present value, term, and type. But you'll also see I have cost, future value, and net value. These are calculated fields. So once I have that data in here, I have the example, type, present value, additional payments, interest rate, term, and compounding period. That's what I just had in Excel, right? I don't have these 3 yet. But what I want to do is I want to show you, so this right here is just a typical chart. So if I was to open up this visualization and I was to click on this, let's click on it so I don't get it to filter. But so if I click on this, see it right here, that's just a table or chart. Okay. But what I want to do is I want to get those fields in here. So how do I get those in here? So let's start with the first one, future value, right? So if I click on this, that brings up my calculation. So just like with Excel, we're going to have the FV function, see it right here, FV. And then what we're going to have is the same thing. You have to take the interest rate and the compounding periods, right? Because the interest rate is for a year, but we have to divide it by the number of compounding periods. So I have sheet 1 interest rate, okay? And then I have sheet 1 divided by sheet 1, which is the sheet 1 is this. That's where the data is. Compounding periods, right? Then I have a comma. Oh, let's see if we can get that back here. Now I have this comma right here. And then I have next to it compounding periods, right? And term. But that's compounding periods times the term. And the reason being is, so in this case, I've got 25 years, right? And I've got 12 compounding periods per year. So I need to multiply the two to get the total number of compounding periods. Then I put another comma. Then I have the additional payments, and see that little negative in front of it? What that means right there is that I need to have a negative because it's a what? It's a deduction. I'm putting that money in. I'm not getting that money out. So that's the way Excel sees it, and this is the way Power BI sees it the same way. So you have to have a negative and then the additional payments, and then you also put another negative and the present value, because you have, those are both your investments, right? You have the present value investment and the additional payments. So once you have that done and you have your parentheses correctly, so you have one parenthesis at the end here, and if I go back to the beginning, you actually have two right here. Make sure you have those two. And then each one of these with the divided and the multiplied by have to be inside their own parentheses, okay? So you're going to have the first part, comma, second part, comma, third and fourth parts. The first part is the interest rate in the compounding periods. Second part is the compounding periods times the term. And then the third and fourth parts are simple. They're just the negative of the additional payments and negative of the present value at that point. So then you hit this checkbox here. When it comes back clean, that you have, there's no errors. If there's errors, it'll be red and it'll show you and tell you what it is. You probably missed one of these or didn't put the parentheses in the right place. So then you close that out, and then you have future value, and then you can bring that in. So if I click on this and you see right here the different fields I have in there, example type, compounding periods, then I have future value right here. See that? So, and it's right there. And it shows perfectly for what these items, because I have that function in there, the FP function. So what it's doing is it's figuring out on 25 years, 12 compound periods at 10%, $100 a month. In this case, there's zero present value. So this guy's nothing at the start, but $100 a month is what this one's doing. And that's what that would have in 25 years at 10%. And we use 10% because you watch my last video on doing compounding periods or compound interest in Excel. 10% is the overall average. It's actually like 9.98% of the S&P 500 since 19 or something like that. So the all-time recorded average for that. If you were to look back at the past 10 years or so, you would end up at about 13.6% average, but let's just use the 10%. Okay, and that includes recessions, Great Depressions, all kinds of stuff. Good times, bad times, everything averaged out in there. So you're going to have some years where obviously you're going to make a lot more money, and some years are going to make less or even lose money. But overall, it's 10%. So if we bank on that, we'll end up in 25 years with $132,000 based off of if we just put in $100 a month. And then we carry this down because I've got the other examples here, right? So if we close this or minimize this guy here, and we minimize the fields so you can see it's a little bit better, you can see then when we carry that future value applies to everything down that column, right? Because I created a column. So under this, you would just hit this new column. Not new quick measure or anything like that, new column, and that's how that works. Okay, so let's close these guys out. So I can bring that back up. So that's our column of future value, and it applies to all these. So you can see quickly if I put $1,000 down, right, $100 a month at 10%, I'd end up with $144. So that extra $1,000 translates into over 25 years of $12,000 difference between these two. If I were to put $1,000 down and $200 a month, an extra $100 a month on top of that, well, that ends up with a lot more money. Look at that, $277,000 over 25 years. And you can see all the different things here. What if it was 5%? Obviously, it's a lot less. What if it was 15%? That's a lot more, $365,000. What if I put $300 a month in there at 10%, $410,000? That's so that shows you there that extra $200 a month translates into more than the 5% extra on the interest rate. See that? And you can more guarantee or be more comfortable with the odds of having 10% than you can 15%. 15% would be over even the 10-year average. Okay, and you can see, you know, what if I put zero additional payments in? Obviously, your payments per month carry a lot of weight. But we also did some other formulas here real quick to show you. So let's bring this back out, and I want to show you something. So because future value, is it really true Well, it is. You end up with this value at the end. Let's say you're looking at this one, right? $365,000, almost $366,000. But you have to understand, you put in $1,000 and you put in $100 a month for 25 years. So your actual cost is $31,000 you put in of real money that you couldn't use to buy anything else. You just put it in there and let it sit. Now, so when you take the cost and you subtract that out, then you end up with this, which is your net value, which is what you want to see. That's your gain. That's what you actually gained off of your money over that period of time. And this grows fast. And I'm going to do another video shortly that's going to show you yearly, every year breakdown of compound interest and why it's so important. So if we look at this, we looked at the calculation for future value. Let's take a look at the calculation for cost. So cost is, we just took the sheet 1 present value plus sheet 1 additional payments times the compounding periods, right, times the term. That's all we have there. So see, this plus the additional payments times the compounding periods and sheet 1 terms. Make sure these are all within the correct parentheses here, especially this part right here. Okay, then once you have that in there, you get this, and on top of that we have the net value. So if I look at net value is this, is basically sheet 1 future value minus sheet 1 present value. You can do this way, or you can take minus the cost. You could put that in there too. I just happened to create, I wanted to create them the same, and I also created the net value before I created the cost, so I wouldn't be able to subtract that. So it's very simple. It's not as hard as it looks to have that. So here I have future value, cost, and net value. And from that, I can quickly see over 25 years why it's important to invest money and to have it in something that's safe and secure. You don't want to necessarily, a lot of people look at this, look at investing in the stock market with day trading. And I hear about day traders that they can make, a ton of money in a very short period of time. They can, but they can also lose a ton of money, and odds are they lose more than they win. That's why you'll see day traders are here today, gone tomorrow kind of thing. So the best thing long run is to invest in dividend stocks, dividend paying stocks, and stocks that have done that for a long period of time, have good stability. So if you can get, the S&P 500 is built off of a bunch of companies that are well known and have been around for a very long time and pay good interest, and have good growth aspects to them, or continuing growth aspects. So this just shows you that, and then all I have here is I have some graphs that show you, well, what if we compare what we had here, these A, B, C, D, E, F, G, H, the different examples by type, by interest rate, right? So what are the gains? And you can quickly see here, example E, which is this one here with the 15%, obviously is paying the most in this case. See that? The most net value. Now I did it net value, I didn't do future value because I'm going to look at what we really gained by example. And you can see here the 15% is this one. You can see 10% or most of them, and then this guy down here is 5%. Obviously he's got the lowest, example D. Now what if we want to look at by example and present value, based on the present value range? So if we look at that, here you have your present value. This is the people that invested 0 at that point in time. These dark blues are the people that invested $1,000, and the orange is the people that invested $2,000. So it doesn't necessarily mean because you invested the most at the get-go that you're going to end up with the most in the end. Actually, the people that did the present value of $1,000, the in-between, did the best. And then these guys, some of them might have had a higher interest rate. E did have a higher interest rate, the 15%. But look at F. F had what interest rate? 10%. But he had a higher $300 additional payment. Then you also have, if you were to go down here, you can look at the net value by example and additional payments. So you can, this is grouped by additional payments, which shows you, so you can see which is more important, putting the money down or paying monthly, and how much you pay monthly. So let's take a look. $300 is purple, $200 is this, $100 a month is the blues, but look, this one's standing out here because he had a higher interest rate. And $0 is this guy over here. So obviously $0 per month was the lowest performer in everything you can see here. And then we also have cost by example and additional payments. So this is your actual cost instead of net value. So you can look at the cost. So F obviously had additional payments of $300 a month, so his cost was $91,000 during the term of the entire investment over that 25 years. And so he did come up with the highest future value, but that's why I wanted to show you cost and net value. So even though he had the highest future value, the highest net value actually went to this one because this one had 15%. So and that shows you the power of the interest rate over time and your money just reinvesting itself and compounding back. So, and then this up here is just cost by net value, an example, just to show you. Obviously, the cost is highest here with this guy here, and that was your F, the 91,000. The lowest cost here, and then your net value. So the net value goes out bigger this way. So this one here, E, only had 31,000, but that's again the one that had 15% interest. So he had a lower cost. Is that going to happen? Probably not to 15%. You don't want to bank on that. So what's C? C is your next highest. Let's see. Its cost was $61,000, right, on 216. So, but he still has very high net value of 216. And so what was C? So C was $1,200, 10%. So that's probably your best bet right there. You're going to end up with $216,000 on 10%. Were there any other 10%ers? You can look at it and see, and you can delve in this. All I'm trying to show you here is A, the power of compound interest, B, how it's easily calculated in Power BI with the FV function. I can pick any time period I want. I can go back to my Excel sheet with the process I'm doing here and change these to be 20 years, to be 22 years, to be 10 years, to be 5 years, whatever I want to look at. I can change the interest rates around. I can add more. I can add 9, 8, 7, 6, 5, whatever I want. I can add and change. What if I wanted to put $50 a month? What if I want to put $75 a month? I can add that to the Excel sheet. Present value. What if I want to have $100 for present value and $100 a month? We could do that. We could change these all up and do different things, and you can quickly bring it in here and see the difference as the different pieces add to it. And then I could filter based on, what if I want to look at just the different additional payments? The difference. So it would be 100, 200, 300, and of course 0. So we got 4 of them in there right now. And I could look at that and compare them back and forth and say, well, which one works best? That's what this is all about. So you can get a deeper read, a quick deeper read into whatever you want to do, where you want to see compounding, the power of compound interest, probably in investments or mutual funds or 401ks or something like that. I hope you found this interesting and informational. I'll post the future value equation again right here. It's very simple to do. Let me just highlight it for you right there. If it'll let me. Let me see. My mouse just got stuck. Let's do it again. There we go. So future value equals FV, the FV function. The FV function is just very useful and versatile both in Power BI and in Excel. And you just have to remember there's 4 parts to it, right? So the first one is going to be your interest rate divided by the compounding periods, and then there's a comma. And then the second part is your compounding periods times the term in years, comma. Then the third part is going to be a negative of your additional payments, right? And then comma, and then the fourth part is a negative of your present value. And the reason why they're both negative is because they're investments. You're putting money out. It's an expense right now that you're investing, and then that becomes your cost. And of course, if you had broker fees or something like that, you should add that to that. Right nowadays, most of them aren't. There's like 0 broker fees, and like Robinhood and Acorn and other avenues. But if you do have them, you should include them. And then they're also a tax write-off too. Well, not necessarily a tax write-off, but they're deducted off of your expenses. So I hope you found this interesting and informational. Please take a moment to subscribe, like, and share. And I've got some other great videos coming out. We're going to do a yearly based on what if you, that's going to be my next video. What if you took the Biden money that they're going to be giving. Let me show you here. So what if we took, hold on here, where is it? It was right here. What if we took the stimulus and we invested that? What if we invested the whole thing? What if we invest half? We're going to take a look at that in my next video. Thanks again for subscribing or watching, and please take a moment to subscribe, like, and share, and have a great day.